Everybody is once again freaking out about interest rates as the bond market implodes. Today we had the first bond auction following Moody's downgrade, and demand was incredibly weak. It's almost poetic because retail bought a record amount of stock on Monday morning, and is now ultimately left holding the bag in a classic bull trap. Now, if you've been following along the channel, you know we've been looking for a pullback for a number of reasons that we'll get into today. And that remains the base case. This is where we shake out the weak-handed chasers and see who really knows how to position at good trade location. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description and stay tuned until the end of today's show. I've got 7 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame so we can evaluate the trend. We know that the trend, of course, is up, but where are our lows and where are our highs? This is the major low. This is the first set of higher lows. This is a soft higher low. This is a soft higher low. The reason being is that the hourly trend never flipped to down. The hourly trend never flipped to down. This, of course, as a gap up, could constitute a soft higher low. I wouldn't really call it one. So along the way, we have lows, but they're soft. And at the highs, we have higher highs, and we have higher highs way up here. So the question I would pose is, are we pulling back from the highest high in the trend count? The answer is yes. Does that mean we can afford a higher low? The answer is yes. Has the hourly trend flipped to down? The answer is yes, and we'll see that in just a second when we move to the hourly timescale. The point being is that the trend is up and we have the opportunity to set a firm daily higher low because the trend has changed on the smaller time frame hourly, which is a good thing. If the hourly trend changes to down, it offers a firm higher low, which is a much better starting place for a new rally to begin from without tiring out the longs at the top of the move. So the next question might become, okay, what's the daily structure look like? Well, the daily candle has a nice upper wick that rejects the entirety of the previous day's range. We have a close that's really weak at the lows of today's trading range, and there's really thin structure off to our left in the lower wick of the gap up open from not this Monday, but the Monday prior. So is it reasonable that this candle might suggest continuation to the downside into our next technical level? And is it reasonable that when we get there, we could be on the lookout for a higher low? I think the answer is absolutely. And as we said in the intro, this is where we want to start thinking about our trade location and risk reward on the long side. If we see buyers step up at 577, the top end of the gap confluence with the daily 200 SMA, is it reasonable that we might get a long entry here with a stop that looks like this and a target that looks something like this, retargeting the equal high on the daily timescale? To me, that is a reasonable outlook here for the market. If we go through 577 and buyers do not step up here, is it reasonable that the market might produce a gap fill reversal, in which case we can do the exact same thing? We could look for buyers to step up at 567.75, manage our risk based on that level, and then retarget the equal high. Obviously, your reward in this situation is much larger, but you do have to battle back up through something like the 577, and in an ideal world, the chart might look something like this with another higher low back above that level. So that's what I'll be looking out for here into the end of the week. If the market does just get follow through right back into these equal highs, this, in hindsight, will be a firm higher low because the hourly trend did change to down. But am I going to be really longing this on the location here? Probably not. The next trade would be a breakout higher low Brigade bolt on the intraday through the equal high, right? That would be an equal high breakout after setting a higher low. This situation would be less ideal because it doesn't really give us an opportunity to participate at the best location with the highest expected value of the trade, which would be a higher low in an uptrend, right? In a downtrend, you would say the opposite. You want to get involved on a lower high. So that's the daily timescale, and maybe another question we could pose here is it reasonable, the location that the market is pulling back from? It is. I mean, we have this overhead supply here. We know that there's been massive divergence at the exchange level, and we'll see this in the market internals. We really haven't had new money buyers stepping up here. It's been a little bit of short squeeze and then just sort of tepid consolidation, if you will. So is it reasonable that maybe this overhead supply is acting as resistance? I would certainly think the answer is yes. So on the hourly time frame, let's just go there now, actually. You could start to see, and we've got more of the helper levels on the hourly time scale. If we do get a rally that looks something that, rejects 588.75, it's a great spot for another hourly lower high, right? If we can go highs, lower highs here, the hourly trend remains down. You can of course see that if this was our last set of lows, notably the gap down open on Monday where retail was piling in, we undoubtedly have a lower low. So the hourly trend has changed to down, which means that it would be reasonable for a lower high to happen here. So if before we get to 577, the market tries to stage a rally that rejects underneath 588.75, let's say it maybe looks like this on the 15-minute or something, you get a 15-minute double top, it's an hourly lower high, we rotate to the equal low here, I would look for an equal low breakdown, and that ultimately gets you to your daily location where it's possible a higher low can be set. Once again, 577, daily confluence with that 200 SMA is really a top watch. So we can short the market here for risk reward to get back down to the equal low. I would say your risk reward is probably not all that favorable for this style fade through this. That's just not a trade I'm really interested in. I would think that the market, because we know we're in an uptrend, we have supporting evidence that's bullish. We'll get into that in today's episode. I would be a little bit more hesitant to try to short for a smaller range into the key area where we're firstly looking for that daily higher low. So this risk reward, not as ideal. If this unfolds, that's fine. Another place where just outright bearish consolidation would happen is underneath 585.50 coming from these lows back here. If all of this is trapped overhead supply and the market just consolidates, it would start to look like what? Of course, an hourly bear flag, in which case follow through underneath the flag low brings you into that first location, 577, where we're evaluating whether or not buyers are going to step up for the possibility of a firm daily higher low. So what does that look like? What is the reversal? What does the higher low look like at 577? Let's just say it plays out as the bear flag. We get here on Thursday, and then on Friday, do we get something that looks like this? If we do, I would want to posture for longs as we were describing on the daily time frame. With risk here, ultimately on the daily time scale, your reward would be the equal high in the trend count. But on the hourly, let's take it one step at a time. The first target might be something like this, a retest of this overhead supply low. You can clearly see how on the hourly time frame, that's still going to offer you something like a 2-to-1, 2.5-to-1, 3-to-1 if we can properly assess that buyers are in fact stepping up at 577 and we have some kind of intraday reaction off of that level. The next situation that of course we could deal with is an overshoot into the gap. Let's just say that the market goes straight lower, an overshoot here into the gap that then finds a higher low over 577. I would be interested in the exact same risk reward. It doesn't have to be bear flag consolidation that then gets there. If we look into the gap, if we test the daily 200 and sellers are unable to find follow through into the full gap close here at 567.75, this first higher low is absolutely a long that I will be looking for risk reward along these lines here. And once again, this aligns with the theory from the daily time scale that we are seeking a higher low. Now, where does it get even a little bit more, what would we say? It's going to cause some nerves for sure. But if we get into the gap, let's say that we go for a flag and then we pull back here, there's no sign of buyers stepping up. We overshoot and instead there's a lower high inside of the gap at 577. If this is the situation, I would certainly be open-minded to shorting this 577 lower high and then targeting the full gap close. Now, when and if we close the gap all the way, once again, I put my thinking cap on and I say, okay, this is a location where on the daily time scale, we are seeking a firm higher low. The daily trend is up. We are pulling back from the highest high. This is a location where buyers should have some response. So I would look to get long here and risk reward would target 577. So let me draw this in so I can actually draw in the risk reward boxes. I'll make this a little bit tighter and then I can show you exactly the trade path like that. And your risk reward would be like this. And then a retest of 577. There's your 2-to-1, 2.5, 3-to-1. And if you can balloon runners beyond that, right? Obviously the follow through to the upside is another Brigade bolt here, in which case we're retargeting the bottom end of this overhead supply. Again, this key level, I know it's hidden at the lower edge of the weekly expected move, 585.50. 585.50. And you could reestablish a new long here. You could, if you did not take the first long off the gap fill reversal, you could reestablish a long that looks something like this around 577 for the secondary entry on that sort of recovery effort towards 585.50, ultimately with the target being, once again, the equal high from the daily time scale way up here at 594.50. So those are the trades that I'm most interested in. And the logic behind this is that, yeah, we've seen some momentum step into the market today. We've seen that buyers are a little bit cautious or just running out of bullets, so to speak, up here towards the highs. We see this at the exchange level divergence, but we have not lost the major trend, which is the daily, and this is the pullback that we've been waiting for, right? We've been saying, okay, if we get a pullback opportunity, we're in an uptrend, we want higher lows. This is ultimately what separates the men from the boys, right? Let's see who's going to step up here, or the ladies from the girls, right? We're all inclusive here. If we could get this 577 or this 567.75, then game on. If we start to see some response from the buyers off these levels, I'm interested in that higher low narrative. Now, if the market's going to give us something that's a little bit more complicated, as we said on the daily, if we just rally straight up over 588.75, I would think that there's a possible hourly long for risk, maybe reward that looks something like this, but you're ultimately just trading back into a range. That's a little bit more difficult because you would not have, at that point, a key daily hold of an inflection point that you're using as a firm higher low. Again, in hindsight, it will look like a firm higher low because the hourly trend has flipped to down, but you're not really at a key reference point yet. The key reference points really step in at the top of the gap and the gap close. Daily 200, if we throw on some additional confluence, you could see our intraday anchored VWAPs, right around in here. There's the cluster that's going to start coinciding with this as time. That's maybe a little too steep, but something like this for the end of the week out of the next one. You got a lot of different support coming in for super support confluence at that 577, at that 567.75. We could also come in here with our Fibonacci's. Let's come in from a number of different spots. Let's go to the daily just to be a little bit cleaner with the levels. If we come in from the, let's go back to the fib tool here. How do you guys like this? I think that this is something we might implement, right? Here's all the hourly levels slapped on there as well. Here's just the daily set. A little bit cleaner, a little bit easier to see. Let me know in the comments if that's maybe useful for our analysis. Notice that we're well above the fib 38.2. That's a no-brainer. We've been saying that for a while. If we come in from the last major low, which was the only firm higher low we have, the gap is completely over that fib 38.2 as well. So let's start walking up the soft higher lows, right? This one up to the highs. Notice that your fib 38.2 is almost aligned with the top of the gap. If we come in from this pullback low to the high, notice that your 61.8 is aligned with the gap close. The 38.2 is ever so slightly above this. Generally, what I think this reinforces is that if these pullbacks unfold, it's not such a deep retracement where we need to just throw the bullish thesis out the window and say, oh my God, the market can't possibly, it can't withhold a higher low here. What are you talking about? This is way too deep of a retracement. Not the case. Right? If you're following along and if you're tracking from the Saturday update video when we talked about tracking the Fitch credit downgrade and what would have to happen on that, as we mentioned on Saturday, you'd need to see continued overshoot of 567.75. You need to then reclaim that area, double top on the daily or something like that. This sets a weekly lower high, right? From here down to here. And this is going to happen over the span of many days. This is not something that happens like tomorrow's Thursday session or just Friday. This is many days. Double top here, and then underneath the double top neckline after setting the weekly lower high, this is where I would be more confident in the short side, probably targeting something like the top end of the tariff turmoil zone. So as of right now, the parallel to the Fitch credit downgrade in August of 23, it's very speculative. I think that the base case, as we've sort of announced in the intro, the trend is up. We are getting a little bit of a pullback here. We're still over very key reference points, daily 200, and then the gap closed down here. There's plenty of opportunity to assess whether or not buyers will step up at those levels, as we just saw on the hourly, as we've been talking about on the daily. What's going on at the market internals? What's going on at the exchange level? If you're not familiar with this dashboard, take a look at the video tutorial in the top right-hand corner. Today we had severe volume outflows only when the bond auction went south. You'll notice that all of the volatility from today's session kicked off at, classically, they host these things at 101, right? Not 1 o'clock even, but 101 is when the bond auction happens, and boom, that's where all your downside volatility comes in. That's where the advanced decline line really accelerates back underneath trend lower zone. That's when your index score flips to negative. That's really where you get acceleration out of the volume flows, and your tick on the cumulative also gets worse. That's focusing purely on today's session and what has taken place. Prior to this catalyst of the bond market weakening, right, and really just not getting much demand there from foreigners, what we saw was, as Monday was shaping up as a pretty substantial rally in the upward direction, no follow-through out of the cumulative build on the tick. You could see that volume flows were lackluster, and of course that's because we closed on Friday near the high of day. Monday opened far underneath that, so less concerning here, but this should be a red flag. out of the cumulative build, just not getting any follow through as the market rallies big time to set a new high, right? You could see your advanced decline line on Monday. It is climbing higher. It never goes positive though. And on Tuesday's session in particular, Tuesday's the nail in the coffin because this is where we saw a little bit of liquidation break. All morning, it's sideways action, and into the close, there's this snapback V-shaped recovery. I'll zoom in on this. What this suggests is that stronger sellers are still not active in the market. If we had stronger sellers on Tuesday afternoon, you would have seen something like this happen with a lower high Brigade bolt underneath the opening range, but you can see that instead, the market closed in the midpoint. The point of walking through this exercise is to sort of showcase that the stronger downside only came in today because of a catalyst. We do not have sellers who are persistently selling the market, shorting the market, finding new money positions to get short delta. It's not the case. So unless there's another catalyst that continues to sort of send the market new information as a short signal, I don't think we have participants who are really looking for an outright Armageddon-style crash. And in my view, with the daily trend remaining up, with the internals really more so neutral, once again, what I would say that even let's take Friday as well for an example. You had sort of lackluster internals. What this would suggest to me is not so much that new money shorts are getting involved or, oh my God, we need to short the market. It's just that buyers are getting a bit tired up here at the highest high of the trend count, which anybody who's followed the channel for any period of time knows you generally want to dial back expectations when the market falls into the highest high of the trend count. And if you're seeking new money longs, your risk is ultimately pullback risk. And that's what's started to unfold here. So all of those things considered, I would say we know the game plan. We know that we're seeking a little bit of continuation in the downward direction based on the daily bar where it's closed, the upper wick completely rejecting previous day's range. If we go back down to the hourly, we can see this, right? There's this little bit of a gap down this morning. The market tries to rally and accept inside prior day's range. Well, it's not really news, but the auction takes place. That's the catalyst the market needed to say, aha, I've got a reason to sell off now. Unless you get a new reason, I don't think that we really have an expression that stronger sellers have been trying to get involved at all through any of this consolidation up here. And there's more evidence as we walk through other components of the market analysis, which we'll get to, but let's get on over to our market profile. If you're not familiar with this screen, this type of chart, check out the video tutorial in the top right-hand corner. What I would want to reinforce here is that value and point of control are higher in today's session. All that would tell me is that there was simply not enough time spent down here towards the lows or enough volume commitment to really suggest that sellers are going to immediately find acceptance underneath this overhead range. Now, I know that's sort of contrarian to what I was just saying about looking for daily continuation to the downside, but the only way in which this might happen, right, because the market sort of, you can think about the market as an auction, right? In theory, the market's always trying to find fair value. If fair value, the point of control basically, or value area, was left up here, it wouldn't be unreasonable that the market rallies to try to get back to fair value. If there is going to be an expansion of range in the downward direction, we would progress value lower by rejecting the overhead supply and then moving lower, right? So you come back in to test that and then look for the follow through to the downside. That's that lower high on the hourly time scale that we were just talking about on the SPY chart itself. The other thing I'd point out from a market profile nuance perspective is just these single prints in H period that divide the session into an upper and lower distribution. And conveniently enough, those single prints are basically right at the bottom end of the range, right? This overhead supply that we were just referencing. So if you notice that the market is staying inside of the lower distribution in the ES tomorrow, that would be underneath, let's just say, 5907s. If we're underneath 5907s, you're probably getting bearish acceptance lower, and we'll look for that full pullback to the top of the gap. If the market accepts over 5907s and we're doing something that looks like this, it's a slightly different story. I'd probably use technically the upper distribution is where those singles stop, so I would use something like, let's go 5913s. If you're over 5913s, that would be an indication that acceptance is trying to work its way back up towards this point of control, this acceptance based on a value area perspective up here. And in theory, it makes our job a little bit harder to trade that outcome because we know that this is a choppy, sloppy zone up here, but we don't want to fight that on the short side is ultimately what I'm getting at if we're accepting in that upper distribution. So that's a little bit of market profile nuance for you on today's episode. Let's jump back on over to the platform here. Let's take a look at the QQQ. I did not parse this out to a daily set. I don't think, did I? Yeah, no, that's not it. That's something old. But let's take a look at the daily time scale. What's going on with the trend? It's the same song and dance as the S&P 500. We've got lows, firm higher lows, soft higher lows. A little bit more of an hourly downtrend here qualifies this as a firm higher low. The gap up, of course, just up and away. We're pulling back from the highest high. What I find more interesting for the short side out of the QQQ is the fact that the market technically looked over the top end of this range. Let me zoom in on that actually so we can see it. Notice that the upper wick of today's session breaks through these highs, and then where do we close? Underneath the low end of this is a balance range. The NASDAQ has been far more balanced in these 5 trading days back here outside of today's breakdown than the S&P, which was trying to grind a little bit higher. So with that, now it's very, very clear where the overhead supply is. Anything that persists underneath 515 on the QQQ seeks that pullback on the daily timescale with the availability for a daily higher low anywhere over 501.50. If we go through that, the full gap close down here gets interesting, and I would say that the play for the equal high would come from these sort of pathing recovery ideas back up into that 521.75. So the pullback seems reasonable. This is, I wouldn't call it a bearish engulfing bar because we did not open over the Tuesday high, but we definitely tested above it intraday and then closed really weak well underneath Tuesday's low, but also Monday's low as well. Right, closing week there. So below 515, I would expect the pullback to continue. I'd be thinking primarily about 501.50 and then the full gap close at 490.50. The daily 200 SMA might provide confluence around 493, which is a minor level from way back over here. This previous pivot high, it's slightly inside of the gap. It's also the high of the Thursday session before that Friday, and then the gap up on Monday of now 2 weeks ago. So maybe carry that one forward as another nuance there. 493 is this previous weekly pivot from back here. All right, that would be the more important of the two. There's technically a level here. I'll give you that one. That's at 497.50s. Less concerned about that one. More so the 493, right? The last thing I'll say here on the daily time scale before we get down to the hourly is just that the overhead supply range here is technically around that 509. If the market just supports over 509, it'd be a little frustrating, just like the S&P 500 conversation we were just having. But if it technically supports over it, I might not initiate short trades to get into this top end of the gap. So let's go to the hourly time scale just so we can see that. You'll see what I'm referring to. If the market is doing something that looks like this, basically, and sitting on 509, reluctant to break down, I wouldn't fight that as a short. I mean, it seems reasonable that the market may try to rally. And then if you are going to try to short this over 509 but under 515, you would want your trade to be established something along these lines, risk reward wise, for the best possibility of actually having some kind of reasonable risk reward on the target to the downside. If you're just shorting this into support, it's kind of poor practice from a technical analysis perspective. What you would need is the classic Brigade bolt below 509. Then you can target 501.50. Like the S&P, we'll be thinking about longs here for the first attempt at a daily higher low to preserve the daily uptrend. Then we will retarget this. We will look to then Brigade bolt over 509 into 515. Your risk reward would develop to look something along these lines, right? And then from there, we'll start to retarget the equal highs. If the market, this would be the funniest kind of situation I think that the market could throw at us. If the market ends up opening over 515, don't forget about balance rules. Balance rules tell us that this could easily turn into a look below and fail on an open over 515 that then Brigade bolts for a higher low here. And in theory, the target of a look below and fail is always the opposing end of the balance, which in this case would be these equal highs at 521.75. Kind of, again, definitely a frustrating trade to take with all of this consolidation and chop that you have to work through. However, with the first taste of a little bit of downside, I honestly wouldn't be afraid of maybe saying something along the lines of, if this unfolds, it could happen sooner rather than later, just based on the premise of short squeeze. Anybody who piled into this short close to the lows here thinking, aha, this is the moment the market's going to crash, I'm going to get short here, instead of just saying, okay, let me be patient for the pullback. If this is their location, they may squeeze on an open and sustained support over 515. So don't write that off as a possible situation as well. What else do we have here? So we covered look below and fail if we open in range. We covered consolidation here. Got to look for the Brigade bolt underneath. There's definitely a short to be had. Like, this is a short that I might entertain from A to B. And then at B, I would wrap it up. If the market goes through point B under 501.50, again, that 493 becomes a little bit more impressive. That might be point C, with D being the full gap close. And at CD, I would certainly start thinking about the full gap fill reversal for that daily higher low, as we were just mentioning, right? It's the same rinse and repeat of what we were talking about in the S&P 500. You have, this kind of idea here, great. Brigade bolt there, back higher, you work your way up. If you come all the way in, you do something that looks like this. You can short this one because there's much more range to trade for. Maybe it looks like this. And then we're also long here, looking for that risk reward back to the upside, right? So that's your pullback situation in the QQQ. It's the same song and dance as the S&P. We could throw on the intraday anchored VWAP, see if we're getting any confluence out of these. They're not as well aligned, I'll tell you that. So the one thing I would carry forward is that this anchored VWAP from the gap up on Monday from 2 weeks ago is potentially going to act as resistance confluence with that 515. So just watch out for that. Depending on the time of week, if this is starting to act as support around that 509, it would once again make me very cautious of being short above 509. If price just dribbles down, right, like this, and is meeting the anchored VWAP there, I'd be very hesitant to be a new money short at the level. I would need to go through the level, then set the lower high, and maybe trade into the top of the gap, 501.50, as we've already described, right? We'll come in one final time with some Fibonacci's, bottom of this up to this, 61.8 right at that 509, reinforcing that level. If we just walk it back to the last soft higher low, this was actually a firm higher low because of the hourly trend change here. Highs, lower highs, lower highs, lows, lower lows, lower lows. Notably, this is the defining lower low. Anyhow, point being is that the fibs are not really aligned with that one. That's a little bit sloppier than some of the others that we were dealing with. What about from this low up to here? There you have it, your 38.2 confluence with the top of the gap, reinforcing that level. You guys know me, I'm much more of a fan. If I had to rank order the importance of these things, Fibonacci's are pretty far down the list. Horizontal levels rule all. Horizontal levels rule all. Anchored VWAPs are probably above Fibonacci, and that's kind of my ranking. Okay, so with that, the Qs excuse me, are done here. Let's take a look at the NASDAQ side of the internals. You can see similar to the S&P, so we won't rehash it all, but you get very divergent on the sort of follow through on Monday. There's just no exchange level participation there. You can see we get towards the zero line, but not positive on Monday here. And the same thing out of the cumulatives, just not really impressive at all in the upward direction. Today's aggressive downside only comes in once the bond auction kicks off around that 101 time frame. Same story as the S&P. Let's jump on over here. Let's give that a refresh, I suppose. And let's jump into the NQ. Let's take a look. Our market profile leaves behind a similar trail of the point of control remaining at the top end of the range, and value area is certainly higher in the range. The close is underneath those key areas, the bottom end, as we've been describing. It's closer to 21,250. If we're below 21,250, I would think that the bears maybe have that opportunity for the lower high. If we accept over 21,250, that's where it's look below and fail. There are no single prints out of your NASDAQ side of the market here. You can see A and H period actually overlaps. That's because earlier on in the session, there was actually that odd catalyst, right? That the EU was working on a trade deal for the US, and the market sort of spiked on that around, maybe roughly the 10:30, 11 o'clock time frame. So your A period actually overlaps much more with that H compared to what we had in the ES. Doesn't really make a difference here because ultimately this is all just a balance range up to here towards these highs. Balance rules are in force. If we're below the balance, lower highs underneath should put the pressure on to get into the top end of the gap. And also, I should have brought this up actually in the S&P as well, but if you made it to this point, here's a little extra nugget for you. If the developing action can take place in these single prints, that would be more bearish, right? Because in theory, there should be no issue rotating through the singles. If we accept over the singles, what would that tell us? Sellers couldn't really get the job done or make it happen in the lows of today's trading range. It's the same thing in the ES. If we just go back here real quick, actually that had already closed. That's why we didn't talk about it. There you go, Matt. So there was a reason for it. Your singles have already been retraced, and you're already at the key level, right? So there's that. Let's finish it up here with the IWM, the small cap, see what's going on from that point of view. Daily time scale. We've already closed the gap below. So is the trend up? Let's get back to basics here. This is the differentiating index, right? We're in an uptrend. Yes, we are. We have lows, we have higher lows, we have firm higher lows. There was an hourly downtrend there. There's an hourly downtrend here. This is a pullback from the highest high in the trend count. This could easily become a firm higher low. Something that I think many people might overlook as we head into the remainder of the week is what happens with small caps on this gap fill reversal. If small caps rally back into this range overhead and totally brush off what's happening with interest rates in the bond market, or let's just say that the bond market catches a bid, interest rates come down a little bit, I would certainly use the IWM as a proxy to sort of gauge how the market's feeling about that. And any movement back over 205.85, I believe it is, the bottom end of the range here, would be incredibly compelling on the long side for the broad market as a whole. That's basically small caps calling the bluff of the failed auction on today's session, basically. So that would be insightful. The only hurdle we have to get through for that to actually take place is the early morning data with PMIs, as well as probably more importantly, tomorrow morning, Thursday, 8:30, we will be getting the jobless claims, right? If jobless claims look weak, the market may not so much like that in the sense that the recession narrative gets priced in a little bit more firmly. The only thing, and maybe you heard it in my voice there, I'm a little hesitant to say that with utmost confidence just because Jerome Powell in the conference, the Thomas, I think it was Lubbock, or I'm going to butcher the last name, but in the most recent conference from the Fed where they were going over the framework, right, they outlined that they're probably more concerned about the labor market right now. Instead of targeting 2% inflation, they were bringing up FATE, flexible average inflation targeting, right? So if those numbers come in weak, yes, it might start to concern the market about recession, but it probably forces the Fed to start thinking about cutting rates sooner rather than later, which should, in theory, help bring the pressure down on small caps. So if you just want to trade it technically, watch for an open over or under these two levels here. It's really as simple as that. If you're in between, I would keep an open mind. If you're over 205.85, bulls on parade, let's rock and roll. If we're underneath 202.75, yikes, that spells trouble for your S&P 500. The pullback probably intensifies and we retest the top of the gap, if not get into the gap, for the S&P itself, under 577, right? So that's your daily time scale on IWM. Let's take a look at the hourly time scale. We can clearly see range rules in place. Started to get morning acceptance. There's everything going south with the bond auction and any lower highs underneath 205.85. Keep an hourly downtrend in force. So something that looks like this. The compelling argument for longs would be that this turns into a double bottom, right? And then this is where we trade back on the long side. Any recovery effort here over the neckline back inside of the balance from off to our left. If this cracks and it goes like this, right, this is where we're concerned about the health of the S&P, probably looking for further downside pressure. Let's jump in here with the intraday anchored VWAPs. You can see that we are already testing and underneath this one. This has been much more sideways than the S&P and the NASDAQ, so you're already well below that one as well. Just meaning that there's the possibility, just like the NASDAQ, for this to come down and actually offer a lower high if there were to be a counter trend move to retest that 205.85. So that's how I see the smalls into the end of the week. I think that the base case is probably seeking a lower high here as you know, into the end of the week, reevaluate at this point. If we're underneath, it's sort of looking for the deeper pullback in the S&P. If we support here and neutralize, maybe the top of the gap for the S&P 500. If we just get straight back into this range, S&P may not even make it to the top of the gap. Never mind look into the gap for a potential look below and fail on that 577, right? That's your smalls. Let's take a look at the Russell side of the internals. Let's see what's happening from this point of view. Same story, right? Strong volume outflows on the news, total rollover in the advanced decline line, and a cumulative build that really intensifies into the afternoon. It's not a shocker here for the Russell. Rinse and repeat with what we said in the S&Ps and NASDAQ. Let's take a look at the market profile and see what else we can glean. There's much more of a string of single prints, and that's because your morning consolidation, if I just go back here to the hourly, was pretty high and tight. Pretty high and tight inside of this range as the broad market from the S&P and NASDAQ were gapping down a little more so towards the bottom end and then really rallied almost all the way to the top end. Remember, the upper wick of the NASDAQ bar broke the highs. Your small caps really didn't do any of that, right? So the breakdown was happening more so from the low-ish of day, midpoint of day, rather than some sort of miraculous high of day and an extension from the opening print. Point being, back over on the market profile, your value area did shift lower, your point of control is lower, there's a larger string of single prints. Any acceptance on smalls underneath 2070 probably tells the story that it's likely lower instead of higher. If we're over 2070, thin structure retracement, then it becomes a battle for whether or not markets will accept back over 205.85. That is your small caps. Let's take a look at the sectors for the S&P 500. Let's begin with our weekly performance. Let's filter this quickly by losers and leaders. There we go. Leading the weekly performance by a whopping 20 basis points is communications. Then we have the semiconductors, still green on the week, up 3 basis points. Leading to the downside is energy. Then we have real estate, so all your rate-sensitive stuff, really. Financials down 201 basis points. Discretionaries in there. Healthcare, the tech sector. You know, a lot of red across the board, which is totally reasonable considering that the pullback's taking place. What we care about is in these charts, and hopefully, you know, anybody who watches the entirety of the videos from, you know, day in and day out, you guys probably know what I'm going to say, right? What did we talk about on Saturday? There's plenty of room for a higher low to be offered on a daily pullback. There's no concern about a trend change here. I'd be far more concerned in the XLC if we had already pulled back to here and a rally was starting to reject here on a lower high. It's just not the situation. So take this same concept and now apply it to basically all of the charts we'll look at. Look at the SMH. It's still inside of this previous range. On the pullback, it's not even into the gap yet. If it closes the gap, is that a higher low in the daily trend count? Absolutely. Absolutely. Pulling back from the highest high. In a picture perfect world, it doesn't get there, holds up over 237. The threat will be, like, I fully want to acknowledge this, right? If the gap closes, this will be a threat. It will be a threat, and it will be something that we have to deal with when and if it takes place. But for now, the base case is that higher lows can persist. We are still over key support. We are not speculating that this is the must-be outcome. The first thing we think about pulling back from a higher high is, can we set a higher low? Do buyers step up here? Do buyers step up here, right? Let's move along to energy, falling back into its range. That's a little bit more concerning from the recession narrative perspective. Market may be preparing a bit more for that. Real estate, rate sensitive, coming back in aggressively. That's makes total sense with what's going on with rates. So not a shocker there. It's also a lightweight sector for the market, not going to move the needle. Financials pulling in, but once again, ask yourself the key question, what are we pulling back from? The highest high from a weekly perspective, daily perspective, plenty of room, gap fill reversal. Let's see if we can find buyers here around 49.75 over the daily 50, over the daily 200. I would give this the benefit of the doubt as long as it's over 48.65. As long as this takes place, fine. No issues out of financials for me. Discretionary, sitting on top of the gap, sitting on the dock of the bay, right? Right here, can we get the gap closed? If so, then fine. Don't forget about what we've said about the S&P daily time frame chart. It looks like with the rejection purely of Tuesday's range, Wednesday's weak close at the low of day, we can continue the pullback. What might fuel that? Well, let's see if discretionary can get into the gap. If it's underneath 210.25, fine. It's a pullback from the highest high. There's the offering of a potential higher low in the zone. I would keep an open mind for this as continuation after we get there. So I think into the end of the week, it's easily shaping up for the possibility of a pullback. We'll skip bonds for now. We'll get back to them in just a second. We have the XLV, excuse me, inside of a potential look below and fail. I would really be curious to see if this starts to step up here. We know that this is D for defensive. We'll see if that rotates. If it does, if we get something that looks like this, as you get maybe a pullback in discretionary, your S&P is not, it's hardly going to budge. It's not going to look into the gap below. Remember that the XLV is the fourth heaviest weight sector. So although it's defensive, it will keep the S&P afloat. And once again, this speaks to the rotation narrative, which I think is going to become abundantly clear when we start looking at our ratio charts. Let's move into the tech sector. It's a rinse and repeat of the XLK, basically the QQQ even. Here's your upper consolidation. Here's a pullback. Plenty of room for a higher low here. Closes the gap. First thought is a higher low. This is a threat. We'll acknowledge that. But the base case in an uptrend should probably look more like this on an equal high attempt back up here towards 235.75. If it just reverses off of 226.75 to end the week, great. No problem with that either, staying over the daily 200, over the bottom end of the previous consolidation here. Let's look at not builders, but materials. I always do that. XLB, builders. They should rename that. XLM, materials. 87.60s, maybe a pullback, maybe consolidation. Remember, this is the lightest weight sector of all of them for the S&P 500. There's no concern here. We're moving on. XLU, top of the range, offering a classic Brigade bolt. Any concerns? No. It's D for defensive. Even if it was in the range, I would not be concerned because it's defensive. If we look at staples, no breakout through the top end of the range that's been a major success. We could probably come in with another level here. Sideways through here, no problem. No problem whatsoever. We saw a little bit of weakness out of Target. That's a Target thing. I don't really think it's a consumer thing. It's really their management more so than people not being willing to spend. Let's move into the ratios because, as I was saying, and then we'll talk bonds as a more explicit segment of what's going on there. But ratios first, to be congruent in the sectors. If you're not familiar, check out the video tutorial. Top right-hand corner tells you how to set this stuff up. XLK, green shoots, higher low pullback after setting a huge higher high. Obviously, double bottom trend reversal over the daily 50 SMA. It's curling up now. Perfect. This is risk on. This looks good too. Curling upwards, 50 SMA. Higher high was produced on the breakout. Pulling back, opportunity for a higher low. Looks bullish. Risk on. This could use some work. I will admit that out of financials. It doesn't look great here as it's more so gone sideways and it has not produced a higher high in this major reversal to the upside, right? Notice as I hover my cursor here, right? This is the same spot where you're breaking out to new highs in something like the XLK. So this is not participating with the risk on segment of the rally right now. It's not the biggest concern, but I think if anything, just reinforces the idea that a pullback might be warranted here. Are the risk-off sectors outperforming? There's an uptick as we pull back. That's to be expected. It's not a huge outperformance. We're underneath a downward-sloping 50 SMA. Even if you wanted to call it flat, that's fine. Same thing happening here. Does not look like a risk-off rotation where, oh my goodness, buckle up. It's, all hell's going to break loose. Same thing here out of the XLC. Looks good over, punching up and over the 50 SMA on today's session. Google really led the market, straight higher in the morning at least. So nice to see that higher. Let's take a look at the specialized ratios. And by the way, anybody who has purchased from the site, right, our trading charts layout, I forget what I called it exactly on the site, but I just went in there today and I've made some updates. If you want to re-download the document, you can have access to these layouts as well. If you don't know what I'm talking about, tradebrigade.co/trading-scripts. There's some product in there called, I think, chart layouts or 35 chart templates or something like that. We've added all of these new updated ones that I've been using here, just as an FYI. So risk on-off A is certainly still firing green shoots. This looks bullish, higher low pullback. Same thing here, same thing here, same thing here after all of these major higher highs. 1, 2, 3, 4. You can see all good. Add in number 5 down here. Okay, Kathy Woods, how you doing? She's doing quite well. I mean, you've got yourself an inverted head and shoulders breaking out. You're getting consolidation over the neckline. We don't want to put all our eggs in one basket, which is why we have a spread of these indications, but that's also helping the bullish case. If we take a look at risk on-off B, this is, again, all of these are included in the chart package there. So what do we have out of the GCs? I mean, lower high opportunity underneath, a very classic head and shoulders. I would not be concerned about a flight to safety in gold on this massive risk-off rotation if this is the circumstance out of the ratio. If we look at TLT ratio to the S&P, huge new lower lows today. I mean, even as the bond market and stocks took a bit of a beating, bonds are not being fled to as a safe haven asset as of this moment. They were down more than the S&P, of course. If we take a look, let's double check that quickly before I start saying things sideways. Bonds down 84 bips versus the S&P down 95 bips. Inverse, small uptick on today's session. Am I not zoomed in close enough? Kind of flat. Very, very, very mild. Anyways, not a pure play flight to safety. Oh my God, let's flood into the bonds. We're not seeing that, right? Even with higher rates, which is kind of telling. If you look at the Sailor Shift tool, it's rolling over a little bit, but look at Bitcoin breaking out to the upside. This is a pretty positive look here for risk on. You guys know my take on Bitcoin. It's that this is purely a risk asset. It is not a inflation hedge. It's none of that. It's a risk asset as of right now until proven otherwise via mass adoption, utility, so on and so forth. So we don't need to go down that rabbit hole, but it is more of a risk on indication. Let's move into we can take a look at the dollar and rates. The dollar moving lower, I would have to say, is due to sort of the failed auction, right? And the Moody's credit downgrade. You're getting de-dollarization. You're getting currency going back home. And I think that's putting the pressure on the dollar, of course, even as interest rates rise, which is just because, the bond market did not have any demand on the auction today for the 20-year. So rates going higher. The other thing I'll point out here is that rates are honestly not that much higher than when we began the year. So, I mean, you're mildly, let's bring out the measuring stick. We did this on Saturday as an exercise, a thought exercise, right? You're up 31 basis points on the 10-year on the year. You're not breaking out through this high. You're not over 4.8, which is what we talked about in the weekend newsletter, seeking follow through for upside, where the market probably puts on more of a panic style move to the downside. That's if you're over 4.8 on the 10-year. We could swap this out quickly for the TYX, which is the 30-year. Anybody who's on Thinkorswim and you didn't know the ticker, there you go. TYX will get you your 30-year. You did break out to new highs on the 30-year. The longer end of the curve is pricing in still more concerns about a number of things, inflation, but also just government deficit at this point is what I would say is happening there. If we just go to bonds relative to themselves, you could see, and we're having this conversation all at once. We'll get to the TLT in just a moment. Long end of the curve is outperforming here. Short end of the curve is not underperforming, so the market's not forecasting as many cuts from Jerome Powell or the need for him to even step in the first place and save the labor market, which I think is interesting. The tension for me, I think, is going to reveal itself when we get closer to the August, September, October timeframe, and we really have, because Jerome Powell has been very clear, right? 1 month doesn't make a trend, right? We learned that back in the sickness, so on and so forth. So if that's his approach and that's going to continue to be his approach, he's probably looking for 2, 3, maybe even 4 months of data. I'd say 3 is the sweet spot, right? A quarter's worth of data to determine whether or not tariffs are having an inflationary impact and the labor market, needs to be saved. as of right now, we're hardly like half a month through that. So we've still got many more months to go. And I think that this is going to continue to be a watch. But for now, the longer end of the curve is definitely shouting at the basically fiscal side, saying like, hey, nobody wants, nobody trusts that the deficit is going to be reduced in a meaningful way with maybe some of the tax cuts that are potentially taking place. Let's go to the TLT and see what the bonds have to say to it here. This is the, iShares 20-year TLT long bond. I've put on a swing position here. I always like to tell you guys when I'm actively in a swing position, especially in the bonds, it's just kind of been a rinse and repeat trade for me recently over the last, year and a half or whatever. So as we gap down on the on the Monday session, I was putting on bond short puts in bonds, which is technically a long position if you want to invert that, right? At the 80 strike going out to June. And now today, as we broke the 85 handle underneath here, I put more of it on at 80. And the premise for this, and you have to understand that this is not a recommendation for you to do the same thing. Your tolerance is different than my tolerance. I have different goals for what I'm trying to do here. My goal with the bonds has always been, I will put something on for, if the volatility is there, if I can sell credit for a reasonable amount, I will put something on if I can capture a 5% yield. And based on like a quick forecast, you could start yielding 5% in the TLT at 80 or below. Now, I'm not selling like enough to encapsulate 100% of my portfolio concentration. It's a small segment, but I'll either take the credit and they'll expire worthless, or I'll have some component of my portfolio that's a little bit more defensive, farming a 5% plus yield, continuing to possibly look for different entries as and if bonds move lower than that. Now, am I forecasting a move to 80 that breaks through and getting assigned? Probably not. I mean, the intent of the trade so far is to just capture the heightened implied volatility. And honestly, based on the Monday rally, Tuesday's inside bar, the credits are about the same. It's almost flat from the initial sale on that gap down from the Monday session. So I'm feeling good about it. Again, it's the June series and beyond. I did it in a couple of tranches, so they're not all the same expiry, but June and beyond is kind of where I'm hanging out there. And near the 80 strikes, some below 79, 78s when I was collecting some credit there on today's session. And again, that's just giving you some ideas here about where my head's at in the bonds. And I think if the Fed is going to respond to a struggling labor market, even if those do get assigned at 80, I would have to imagine that the TLT, Fed responds, right, and cuts rates. TLT is probably at 95 by the time the Fed really starts jumping in there and lowering rates more aggressively, right? So TLT, interesting stuff. Bonds have been getting blown up. No demand in the auction, but I think that's primarily because of it's the first one post loss of all AAA ratings. No more AAAs for the U.S. So long-winded discussion about bonds. What else can we say about bonds? Let's take a look at the inverted ZT. This will be a good segue, as we typically do, into our fundamental take, which is more so related to the Fed tracker. Kind of stable here, which is not going to be a surprise as we bump on over to the Fed watch. We're still dealing with about 94% odds of a pause. All set there. What we're watching for is whether or not the number of rate cuts into the end of the year changes. As of right now, we're pricing 2, which is what the Fed's SEP from March actually outlined. So honestly, nothing has really changed from their outlook perspective, given some of the Fed speak that we've heard over the last couple of really days. It was peppered Monday and Tuesday. As we look at the economic calendar for the upcoming remainder of the week, once again, it's the jobless claims tomorrow morning that we care about, initial scheduled for 2:30. If we stay around that zone, then that's honestly not a bad spot. Really still well contained underneath the 250 ceiling as we zoom out here, right? Anything over 250 starts to become a major concern, and you're getting a change in trend out of this sideways stagnation ever since the sickness kind of came to an end in terms of its impact on the labor market, right? Manufacturing PMIs, they're the flash, so they will be important. That's 15 minutes into the bell for tomorrow's open, so just be prepared if you're trading that. Little volatility off the open. It's probably worth just holding off and looking for the response after that. It's pretty tough to find a trade 15 minutes in that, unless it's a quick draw McGraw 2-second scalp. Just let that go through, and then once the market responds, we can gather our thoughts, build a plan, and move from there. Some more Fed speak to end out the week, and just for anybody who's curious, right, we of course have a bank holiday next Monday, so your swing trades, you will have a 3-day weekend with Powell speaking. Who knows what the administration is going to say? Anybody who's swing trading, just be aware that the bank holiday on Monday gives you an extra day of headline risk. As we move into the earnings calendar, there's really nothing interesting here that's like overly had my attention. Palo Alto on the gap down today, Target sort of not reporting great numbers, and then Snowflake is actually higher in the after hours. Let's jump back over to the chart and let's quickly look at it, because you guys know me, I have a nasty habit of saying, oh yeah, we'll look at it before we end the video, and then we don't look at it. In the after hours, as I flip my crayon back to white, we're 191.40 by 50 from a close at 179.12, which gives us a gap up right into these previous highs. For anybody interested in trading Snowflake, we'll maybe do a quick look at it tomorrow morning in the pre-market prep, but I would think if there's a look above and fail here, reasonable to close the gap if the broad market's pulling back. Right? If Snowflake's gapping up in a broad market environment where we're just going to go down and continue the pullback, I would think that you want to look to short this relative strength, because there's no, if Snowflake is not, let's frame it this way, right? Snowflake is not Microsoft. Snowflake is not Google. I'm not going to call it like bottom tier tech, but it's just not in the same category as those high flyers, so to speak. I should dig into the numbers before I make a bold claim like that, but just from a technical perspective, from a market mechanics perspective, if the broad market's fading, I don't think Snowflake has what it takes basically to produce relative strength over this high. I would look to fade the gap if that's the situation, okay? So that's my quick take on Snow. You could also use the overnight high, not this high, but the overnight high. The high of this bar, to give you an idea, is 194.40. 194.40. Let's just quickly, because I hate leaving this like undone and not being all the way there. Yeah, 194, almost spot on. Almost spot on with that previous pivot. So you get the idea. The pre-market stopped right there, post-market stopped right there. If we fade under the opening print after failing that level, I think it speaks for itself if the broad market's pulling back. All right, that was not intended to be one of the 7 trade ideas. So technically speaking, you got 8. You got 8 for today's episode. Let's finish up the supporting evidence before we get into those ideas, then we'll send you on your way. Let's jump into our credit spreads. Any issues from this perspective? Let me just flatten that S&P down there. Any issues? No. Possibility for a lower high. Possibility for a lower high. Even if it goes further than that, I would entertain a weekly lower high up here out of credit spreads, which continue to enforce that this is still a bullish market until proven otherwise. If we take a look at the HYG, so junk in isolation, it's been signaling more of a pullback. We've been talking about this from a divergence perspective for a long while now, really ever since this took place. Yes, the gap up sort of sent it higher as well in here, but it never really got follow through. You're getting lower action there. It's been divergent. We've been talking about not wanting to be long at the worst possible trade location for a long at the top of the move as these divergences have been playing out. What about the LQD, which is the corporate grade side? You could see breaking down to new lows, as a matter of fact, which of course, as an equivalent, we are, look at this, right? What I'm doing is as I'm comparing this kind of level to back here, that would be your tariff turmoil, like fake out pullback 2.0. Right? So massively divergent out of the LQD, continuing to signal like, hey, caution new money longs, literally at the tippity top of the move. I don't think anybody who's really made it to the depths of the analysis that we conduct in Saturday and Wednesday and every morning, nobody should really be shocked about this pullback, right? Let's jump into Bitcoin. We already talked about total breadth, mild contraction, but nothing overly concerning where it's, oh my God, the market should crash here. The market should crash here. Still near the 50% handle. You're around the flat line out of new highs versus lows. Kind of typical after you've made a substantial rally back to recover almost. I mean, not all of it, but darn near all of the drawdown from the tariff turmoil. Let's take a look at RSP. I think this is a mild, not concern, but data point to carry forward that supports the pullback deepening, right? If you look at this, previous resistance, you're underneath on the RSP. What does this tell us? Well, Google is probably responsible for propping up the S&P a little bit more so than the equal weight segment of the market on today's session. So you strip out some of the relative strength from Google. If you get tech weakness tomorrow, you're probably looking at a deeper pullback to, again, start testing the top of the gap, get into the gap, and see how the market responds when we get there. As we take a look at NASDAQ, equal weight is much more on par. It's not even close, right? So see how there's the difference there versus here. It's because the NASDAQ's heavyweight tech anyways, even the equal weight version, right? As we look at, let's get into volatility. Small uptick, nothing to be concerned with there. Let's go to the VVIX down below. Again, nothing to be overly concerned with. An uptick is totally reasonable as the market pulls back. It's totally reasonable considering what's happening with the bond market. What I find most compelling, let's go over here to the volatility futures. I just updated the new contracts because we had a VIX expiration on, I think it's, was it today or technically yesterday? This morning, yesterday's close, right, for the VIX expiration, but you're still in a contango mostly across the board, and we can confirm this over here with, let's not get Snow, but let's get VIX futures, and we look at the curve. Someone was asking if I could explain this. We've explained it on the channel before, but one more time. this basically tells us that the risk in the present day is less than the risk in the future, right? Look, this is time across the bottom. The magnitude is the level of risk, right? It's the VIX, basically. It's the value of the fear index. More risk in the future, more risk in the future, equal risk in the future, and then the market starts to see a little bit less risk in the future, right? So this is primarily a contango curve, which is actually a good thing for money managers to want to allocate capital. If this was inverted and we had a curve that looked like this, which is what we had during the tariff turmoil, what that tells us is there's more risk right here, right now, than some unknown future. So let's just wait and be patient until we get less risk in the future. We're not dealing with that. We're currently in the situation where there's less risk now being priced in than some unknown future. So once again, this curve is more bullish for the market, more of a risk-on indication. So as I sit here and say, I'm still willing and being open-minded to finding that higher low pullback in the S&P, this is a huge supporting data point for that thesis. Let's get through the core list of companies and let's rip through the 7 trade ideas. It's quite a few, so let's make it quick here. NVIDIA, nasty engulfer / upper wick, same story as the QQQ basically, right? 129, top watch, has to be. Why? Well, if you zoom out a little bit further on the daily, it's all the overhead supply. If the market can hold up over that 129, bulls are still in control here out of NVIDIA. If we break under 129, there's thin structure to retrace. I'd be targeting daily 200, and the gap below 124.50 closes down to 123. Primary outcome should be looking for the pullback to continue, given the upper wick failure to accept over the top end of the balance at 136.25. If we do just get sideways action, the Brigade bolt has to be here on the intraday over 136.25 to target this pivot high at 141.25, and we'll walk it up from there. Let's take a look at Microsoft. What's going on with Softy? Pretty sloppy, actually. So let's go to the hourly, and let's go extended hours off. Where do we want this? Extended hours off. So the trend is definitely up, excuse me, but the nature of the trend is grindy, sloppy, ugly. It's not my favorite chart to be looking at these days. If anything, the trade this morning was honestly looking for this breakdown of 554.50 earlier in the session for a Brigade bolt here. Thin structure retracement just didn't unfold until the catalyst in the afternoon. I would think that the bearish consolidation acceptance below the level probably continues the pullback. It's just a matter of, you've got all these different levels to be assessing in Microsoft. It doesn't seem clear to me which one is the best one given the daily grind, right? If you look at the daily structure here, as this is just higher and higher and higher, it's kind of like, it's exactly that. It's just a grind. It's not like we have this clear set of highs other than this way back here to come back and revisit for a firm high or low. So maybe like 439.50s, but until you get there, it's just kind of very nuanced at all of those micro levels we just had on the intraday. If it rallies back into this zone, then your Brigade bolts do the same thing. If you're here, I don't want to trade in this range. I want to trade over that range for 462.65 and then the all-time high. Let's move into Apple, which closed the gap to the downside today. I'd be interested to see if this can produce a gap fill reversal. If it does, it would be one of the first big signs that we're definitely still seeking the higher low thesis in the S&P. If Apple can go gap fill reversal, if Apple can support in here, that's a pretty compelling argument, right? We're staying over this key area. If it doesn't, I would think that you're in store for the deeper pullback in the S&P because this is the top end of the tariff turmoil zone, right? Moving along to Nancy, what's going on with Amazon? Daily 200 SMA, huge inflection point. Let's go to the daily chart actually to see this. So here's your gap up on the China pause, much more meaningful because of the Amazon stores, sellers, all that stuff. Your daily 200 provided a nice long in the morning session, but after that, it sort of faded with the remainder of the news. I'd be watching this very closely because, of course, there's just more gap to close below. If you do get the deeper pullback, it's all about 194.50, 192. I would be seeking longs there for a higher low, pulling back from clearly the highest high in the trend count, no matter how you slice the cake. On the hourly time scale, absolutely the trend is down, right? This. Equal low breakdowns can get you for the full gap close, and then we'll look for the reversal when and if we get there. So this, as a trade, is reasonable, but I would sort of maintain the stance that you need the break through the level first before that's a valid short. I would not just be short above and into the daily 200 SMA. That's the wrong location in terms of initiating a new short, right? You need to be below it first. Let's look at Google. Google is a sloppy one. I honestly hate's a strong word, they say, but this is something I hate. The price action in Google has been all over the place. Pretty tough to make heads and tails of what it's trying to do at this breakout point, right? You had all these equal highs, kind of a lackluster hold above, snapped through it, rallied right back through it, like all over the place. It's a back burner watch. I'm not even going to get down to the hourly for it. If we look at the metaverse, I think the metaverse was going to, like outside of the bond auction and things going south today, was looking really solid here, right? We knew that we had this Brigade bolt on the daily over the 635.25. The detriment of this now is that this is possibly, that's rough. This is a lower high, and any sort of equal low breakdowns through 630.75 get you to the top of the gap, if not through the gap, into 605.75. So I'd be watching Meta for shorts on the reversal here and the failure of this, what could have been a breakout and reversal up to the highs, barring any of that bond news, right? Or the auction, rather. Now it's a lower high, and if we just get equal low breakdowns, the trend is firmly down. We look for the top of the gap close, fairly straightforward to the downside. Next up is Tesla. Tesla. Sideways in the range. We talked about the fake out there on X. If you're not following us on X, you can go find the clip on our account there. But it's classic, right? Tesla is doing the same thing that it did back here at the daily 200 SMA. I would sort of give it the benefit of the doubt as long as it's in this box, seeking long still. If it's a pullback to 326.50s, great. That's a great opportunity for risk reward back to the upside. Or we just remain patient, and ultimately when and if it can find the proper intraday acceptance over 349, then maybe we go with it. You might even say, okay, this is now a range here. I want to clear that. Remember that Tesla has until 377 next resistance overhead. So, risk reward wise, there's enough room to trade there. Even if you're using, not even, but you should be. If you're using smaller timeframes intraday, if you could pull off risk reward and Tesla goes for one of its ripper, 3%, 4%, 5% days in the upward direction, that's going to be a payday that clearly takes out any of the paper cuts from the top end of the breakout point in here. It's the same thing as what happened at the daily 200, right? If you got a piece of it on this breakout here, if you got a piece of this continuation there, really strong stuff. If you're managing risk effectively, well worth trading Tesla on those large days. So that's that. Where would I change my tone to short? Maybe underneath this. I don't know that I would even be short there. Logically it makes sense, but I would still be on the long side, I think, based on the daily breakout of the double bottom here, right, over the neckline. I would be thinking long here as a daily high or low, right? Let's move into JP Morgan quickly. We saw XLF pulling back. JP Morgan has not closed the gap yet. If it does, fine, 255 high or low. Let's take a look at Netflix. Failing the all-time high breakout with the broad market today, no problem. If we take a look at the hourly time scale, not to get too granular, but we could probably throw that on there too. Let's go 75 for the sake of round numbers only. Gray, you guys know the deal. Where do we have trades that unfold? In here is still bullish consolidation. I would Brigade bold it back to the highs here over 1195.75. I would trade into 1210. If we drop this, that's where it turns into a classic head and shoulders, right? Underneath the neckline, rock and roll, thin structure retracement, you're looking at underneath 1183, 1160 becomes your target. Let's get into these 7 ideas, and we'll kind of speed round them here because that's a lot. ADBE Adobe is first up on the chopping block. If you take a look at the daily time scale, obviously the trend is down. Look at the distance between the daily 200 and the 50. Trend is undoubtedly down, but it is over the top end of this earnings gap cycle. I would think with this, there's the opportunity for a gap close, and then it's up to you. It's up to you. I would think the short is the first scalp we can take. There's plenty of range there to trade for on Adobe. Just understand that the options are obviously going to be a bit spready. It's less lower liquidity. Something that looks like this, reasonable, A to B. And then at point B, because I was saying it's over that previous level, right? I would look to button up the shorts and almost say, is it possible it gets a reversal back to the upside? I would watch out for that. So that's an idea here on Adobe. But primarily, the logic behind this trade is very similar to the QQQ, where the upper wick breaches these previous highs. We close extremely weak. I would be thinking that this is a primary trade to end the week. Under 412, targets 405. That's Adobe. Next up, we've got another A name. It's in alphabetical order today. Applied Materials, AMAT is the ticker on that. And the idea here is very similar, where you can see we're already in a downtrend. We produced a lower high today, closed weak on the lows. We're inside of this gap. If we get down underneath these equal lows at 162.50s, here it is on the hourly time scale. Notice the rejections up against these flat highs. If we're underneath that, this is your target. 158.15, 156.50. This zone right around in here. So seeking bearish Brigade bolts into that level. When we get there, daily tells us, right, gap fill reversal, just like the broad market, should then take over as the primary outcome. Right, so that's AMAT. Next up, we have another A, another semiconductor name, ARM. Let's move into ARM. Similar story, upper wick rejecting the daily 200, all these equal lows. This one, I would say, if you're a little hesitant to short it, that's fine. I would be more open-minded to this higher low. We're clearly in an uptrend. We're pulling back. We're off the daily 200. If we pull back and then come into a retest, I'd be thinking about longs off of that 123.75. Can we get, notice how clean this is on the hourly, right? Look at this little reaction right here. This is a classic Brigade bolt, right? Classic Brigade bolt there. Can we get a daily Brigade bolt now that looks like this over the same level? We're seeing the response off of a very nuanced area. Let's watch for it again. 123.75, that's ARM. Next up, we have two C names. First is Cisco, CSCO is up first. And what we can see here is very similar to all the other names, where we've got this gap to close to the downside. So lower high, lower high. Can we break the equal lows? Can we get under 62.95, close to 61.90s? Something that looks like that. Would I be looking to reverse this off the gap close? Perhaps, right? It's very similar in the sense that you have previous highs. You're in a pretty severe uptrend off the lows from the capitulation move. So a little bit of frothiness gets taken out on the gap close, and then a reversal. Sure, not the end of the world. But the primary outcome to watch for is the bearish inverted hammer, daily superimposed, right? Like that. If we crack that low, looking for this gap to fill, right? That's under 62.95, 61.90. We've covered it. Let's move along. Another C name is going to be CVNA, Carvana, of course. And looking at this, you have a higher high in the trend count, but you have thin structure underneath. So this one goes either way, right? The structure here, in terms of literally the daily bar, flat flush point. You could say it's really sloppy, right? But left head, huge right shoulder, a deformed head and shoulders. But if you get something that looks like this, look at the thin structure, right? When we get into this zone, I would button up the shorts and say, okay, is it possible to find some kind of long off of this area? But the flat lows, that's really what we're after in today's episode. These flush points, very, very clear. That's why we have so many trade ideas. A number of these names are playing nicely. Next up is KO, Coca-Cola. Warren Buffett, how you doing? I heard that he's not actually going to be at the next shareholder meeting, which is kind of unfortunate. It's like, you hate to say it, you kind of hate to see it too, but it's the end of an era, right? Kind of, legendary stuff, that guy. KO, Coca-Cola, really tight range. I think this could go either way. I think that we would want to use the broad market as confluence to help gauge our decision-making process here. Clearly on the hourly, right, you can see that. If it is just a bull flag as well, then over the top at 72 kind of rocks and rolls in the upward direction. It's pretty immune to the bond volatility. Classic is that this is the XLP, right? It's consumer staples. So it's going to have a little resiliency to it. So maybe partial to the upside, looking for this, and then follow through these flat highs into the thin structure at 73.35 as a possible target there. If it breaches the lows, like, don't get me wrong, there's still thin structure to the downside too. If the broad market's falling off of a cliff and you want to try to stab short here, be my guest, but this is probably one of the more resilient names, and I think that there's just pure evidence of that from today's session, right? So that's Coca-Cola. We've got one more for you. It's Uber. U-B-E-R, if we could spell. And this is another fan favorite, but we got to zoom out on Uber. Let's go to a weekly. Look at this weekly base. Look at this breakout. Look at the pullback that's starting to unfold. Anybody who missed it from these areas down here, right? It's really all about, can we catch some kind of re-entry at 81.80? Is there something at 86.65? Let's go down to the daily time scale now. The classic is like, this is Brigade Bolt 1. Can we get Brigade Bolt 2 over 86.65? Previous pivot high from back here. That's really it. Like, the pullback is coming in already. It's from the highest high. The name looks good. You have, not to like bandwagon the whole Bill Ackman thing, but he's still involved in Uber, of course. You're getting a lot more coverage out of Uber ever since Ackman announced his stake, and the company seemingly doing well. So that's Uber. That's the idea. Can we get a pullback? Can we find buyers around 86.65? Could be a longer term idea. It doesn't have to be a day trade, doesn't have to be a scalp, but that's the level that I'm interested in because it's been very, very precise with its technical holds in the structure that it's building out. All right, that's what I've got for you in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. You guys are still yet to hit the 5,000 like mark on the pre-market preps by the time the sort of like delisting of them, they go private at 4 o'clock, right when the market closes. You're not there. If you want a picture of the brass abacus, you guys know what you've got to do. Hit the thumbs up button, like the video, subscribe, all that good stuff, whatever YouTubers are supposed to say. I'll see you up in the office tomorrow morning for our jobless claims at 8:30. And with that said, have a green trading week. I will see you in the next one.